Hey everybody, welcome to Stock Trades. In this video, we're going to go ahead and merge some technical analysis into our discussion. Now, a lot of Wall Street analysts and a lot of CMTs, which is essentially a certified, glorified technical analysis professional that works for a specific institution that trades stocks or holds securities, such as JP Morgan Chase, Wells Fargo, etc., etc. My job is essentially to basically tell you what others are looking at. And what we like to do, especially in our Mastering Stock Market course, is that we like to go ahead and merge fundamental analysis and technical analysis together, which is unfortunately not well done. So what I wanted to basically show you here is the 200-day moving average, approximately 22-year history of the S&P 500. Now, a good indicator that we like to look at is when is the S&P 500 simple moving average, specifically the 200-day, going to go ahead and cross? Now, unfortunately, this cross today has been rejected. Now, I'm going to have to say this again. The cross for today has been rejected. That's not good, right? I wanted to inform you on this, okay? So I don't know if you've been seeing this, but there's been a lot of chatter regarding, this looks exactly like the 2001/2008, great financial crisis of the dot-com bubble. The reason why is it because you see that little red dot right there? Because it failed to cross that 200-day simple moving average, especially right here. And then now we have another cross here. Again, my job is to kind of break this down into an easy cookie to help you essentially get this data in. Now, these are outliers from what I'm looking at in the data. And when I mean by outliers, majority of time after 2 days, that's why the magic number is 2 days, these failures tend to go in. And, these failures of rejections tend to essentially go in and basically proceed on in and go up the moving average and continue trotting along in growth, right? So as you can see here, these are all the times they've been breaking. And every time you get one of these bad ones here that failed, you get a bunch of people saying, hey, 2001, 2008. I'm just telling you, 2 days. Reason why is once we go ahead and go from 1930 to 2022, we do a statistical analysis and we say the S&P 500 after being rejected in the 2 days after approaching the 200-day average, you can get essentially, if you aggregate all this data, the last time we've done this was in 2008 and also 2001. In those years, we were down negative 23% and let me show you here. You see this negative 23% and also negative 33%. I just removed my picture so you guys can see the data because, I want you to learn. So, but the thing is, if you take all of the other aggregated datas, 1973 was bad, 1930s was bad. That's why Dr. Michael Burry was talking about these and using these data. But come on, Dr. Burry, you have to take in all the data and aggregate it together. And from what it looks like in the short term, within the 2 to 3 month term, we may be headed down and just dropping. However, if you look at it from the long term 1 year, it looks definitely bullish. Okay, so from the 1 year perspective, it looks like we're going to be up around 11%. But again, this is as a positive predictive, valued around 54% that this might happen with a Z-score of 0.4. So what I'm basically trying to say here is that the overall greater outlook from a year out looks good, and we may get another opportunity for stocks to essentially come back down. However, when, for ones that you've looked at and completed your intrinsic value calculation, it may not go as low as what we may have seen before, but definitely something we want to basically take advantage of if it does happen. So I'm going to shift back here because there's a couple of other things, because again, it's not just black and white. There is some gray. So right now, if you look at the all of the stocks within the S&P 500, a lot of them, unfortunately, 60%, we always like to look at 60%. Anything greater than 60%, it is a healthy stock market. That means 60% of stocks that are trading above here, if the blue line was above this dash line, means that 60% of stocks are trading above their 200-day simple moving average. Right now, we're just not there. And that's still an uneasy stock market, okay? Right. So, but I do have to say, this is where the confliction and the gray area is. The Dow, which is the most respected, collection of stocks that are, pretty, I would say stable. This did cross the 200-day moving average. And we're going to see if this is sustainable. From what it looks like, this is good news, right? But again, that's why I'm trying to give you all the data and you come up with your own analysis, right? So, and I'll tell you what my analysis is. So if you look at the Dow Jones after 3 months with at least 1% below the 200-day, then trades above 3 days later, you can look at it and it's extremely positive, right? Especially definitely on the year out, but definitely positive. So you can see the argument from the S&P 500 and then the Dow. It would have been easier if the Dow was negative and everything was negative, then it would be easier to be bearish. But you can see there's a lot of conflicting data sets here. And you have to understand, this is why Dr. Michael Burry is negative about the stock market, because he's looking at this and he says, if this fails in this test, the last time we got this was in 2008, 2001, and then all the other red ones, you've obviously got positive ones like 1990, 1988, but definitely during 1973 and 1977 and also 1930. This is when we do these aggregated statistical analysis. I'm just kind of, giving you the thoughts of what's going on inside Dr. Michael Burry's head. So that's pretty much all I have in terms of the data sets. If you like our analysis, please consider subscribing, liking, commenting, and sharing. I like to essentially break down and give retail investors a fair shake on Wall Street to show you what they're looking at, how they're thinking. I have other things I wanted to talk about, but I wanted to make this video short, and we're going to go ahead and talk it on the next one. So if you like it, please consider subscribing. Also, we also offer our amazing course, and as well as our software. You can read about it with the articles, which I'm going to start posting down below if you guys are interested. It is a privilege and honor, and I will see you on the next one.